The Bank of Canada hiked rates again today, upping it by 50 basis points. This is now the sixth rate hike in a row, dating back to March of this year. And while the experts had priced in 0.75%, we got 0.5. Either way, we are now up to an overnight rate of 3.75, up 3.5 or 350 basis points this year. Understandably, this is radically transforming the lending landscape and, of course, affordability and the prices of housing. Buying power is now down a whopping 33% from the beginning of this year, and some mortgage payments are increased by as much as 70%. Understandably, this is obviously going to affect housing prices. We're down about 14% nationally here, looking to the HPI, and with today's hike, you can expect further price declines. Today, we're going to get into this. We have a special guest, Mikhail Ferreira from the Bank of Montreal. He is the #1 mortgage specialist there. Mikhail, welcome to today's episode. Thanks so much for being here.
Thanks a lot, guys. And here we go again, another increase. So, we expected a 75 basis point increase, which I guess this is the first positive news from Bank of Canada for now, where we didn't see the full or worse than the expectation. But with a 50 basis point increase, it does, it's an overall 71% increase from January. So overall, still very, very, very high, and but maybe it's a step in the right direction.
Yeah, fair enough. So let's explore each type of mortgage that can kind of exist out there when it comes to current holders, people looking to renew, and of course, people looking to apply. So touching on current mortgage holders first, I think the people that are going to be affected the most and the most significantly, of course, are those with floating variable rate mortgages, because those payments change when the rates change. So compared to the beginning of this year, if you had a variable rate mortgage, let's again get into the specifics here of what their payment looks like today compared to 8 months ago.
Yes. So, basically the payments today, if you look at someone who had a floating variable, so your payment, in January would, for let's call it $1 million, at the average variable rate was about 1.29%. Your payment was about $3,300 a month. Looking today, your payment is now $5,731 per month, $5,731 a month, which again is over a 70% increase monthly. So that's a huge jump up.
Yeah, you're looking at almost $2,400 a month or $28,000 a year in increased payments. Mm-hmm. Who really planned to have an extra $28K tucked away just for your annual increase in interest payments? That obviously is going to affect people.
Especially if you're fixed income. If you have, no other ability of generating additional income in your life, this is extremely painful, and in all honesty, is going to continue to slow affordability across not just the housing sector, but across every sector, right? If this is going to be, for most people, the biggest payment that they've got in their life, and it just went up it's gone up 71% over the course of 8 months. That's devastating. It's devastating.
Very much so. Interestingly, side note, we have yet to see these type of numbers affect the market when it comes to inventory. Nobody's panic selling. There's no flood of inventory to the market here. So you can almost sense that something might be coming, but as of today, people are finding ways to come up, scrape, beg, borrow, steal, whatever it is to make those mortgage payments, because as we all know, you need to have a roof over your head. And what's the alternative? Go out and pay current all-time high rental rates. Best thing you're going to do is find a way to keep that mortgage.
People are hodling.
So moving on, we've talked a lot about trigger rates, and we felt that, of course, as of the September hike, which was 0.75%, that trigger rates were about to be hit or triggered, if you will. After today's 0.5, Mikhail, tell us where we're at. Have you seen trigger rates take place? Are they going to definitely happen now? What does it all mean for people who have variable rate mortgages?
Obviously, this is the hottest topic right now, and I've been quite busy talking to, you know, a lot of my past customers, new customers, all trying to understand where the trigger is, right? And I would say since the last increase, most people were right there or triggered already. So definitely after this one, I would say that if you had a mortgage prior to April this year, chances are you're triggered at this point. Now, you know, it's important for people to understand that if you have static payments, so your payment doesn't change, but you know the proportion of principal and interest does. The trigger rate isn't the end all be all, because all that just means is that your payment that you're making is mostly or all going towards interest. Now, of course, that sounds horrific, but it's not. It doesn't mean that anything is going to change for you overnight. What you have to do in that particular situation is just manually increase your payment at your kind of discretion, right? Because a trigger rate just means that you've reached there, and at this point, your balance is going to start to increase every month. So, in fact, as you're making mortgage payments, your mortgage balance is increasing. And that is obviously what will lead you into something called a trigger point. A trigger point is when you no longer have a choice. That is when your balance has increased so much, your mortgage balance has increased so much that it's 105% of your starting mortgage balance. So I think most people, to reach that 105% is going to take a very, very long time. I'm not sure that a lot of people hit their trigger point, just judging from what I've seen. But, you know, overall, you should be increasing your payment if you've been triggered, period. Because if you turn a blind eye to it, even though you don't hit your trigger point, what's going to happen is when your mortgage matures, you're now going to have this massive ballooned payment because you haven't been making principal payments for the last couple of years. But, you know, I think in general, it's not that scary. I've had conversations with people where I've seen they've already been triggered, and I said, increase it to whatever makes sense to you. Don't change it into a fixed. Don't make a lump sum. Just increase your payment for now. Now, the reason that I'm suggesting that is just because we also don't know where rates are going to go. Right now, obviously, it's doom and gloom. Rates are, you know, climbing. But if rates come down, you know, that can all kind of self-adjust. But, you know, right now, I would say that majority of people who are in a static variable have been triggered. But once you hit your trigger point and there is no more, you know, you have no more options at that point, the banks or lenders will come to you and say, you have to increase your payment to catch up your amortization, do a lump sum to catch up your amortization again and make sure that your balance is in line, or change into a fix, which again, it's same principle, increase payment, amortization line. The average amortization that I've been seeing for people who were in the low rates, so like the January and before, it's like 60 years plus. It's crazy.
Whoa.
I had one client who had such a low rate on this particular mortgage that there were just stars on their actual amortization because it was probably 90 plus years.
So, goodness. You know, so that person's going to be paying off their house.
Yeah. Well, I mean, you got to remember their payment is based on like a 0.99, right? I don't know. There was a rate floating around back then. Right. So, you know, right now, you know, we're seeing a lot of people being triggered, a lot of amortizations blown up, and there isn't, in my world, from what I understand and what I'm seeing, it's not, you know, people shouldn't be that scared, but, you know, increasing and doing some form of action is the most important part right now. But don't kill yourself for it.
So, Mikhail, like, for example, the last time we had this discussion, and we had a significant oversized rate hike. Just, you know, in layman's terms here, if you're on a fixed payment schedule, right, but you have a variable rate, for example, like I personally do, and you know, my payments were, let's say, on $1 million, you know, mortgage, they were $3,350 at the start of the year, and if I do nothing, come the time of refinancing my property here and rates don't change arguably all that much, I'm looking at, like you said, in layman's terms, a ballooned repayment schedule where I'm going to go from something like $3,350 to, call it $5,700, $5,800 for the same mortgage, effectively.
Yes.
Good math. Okay, so let's talk about the second group here, Mikhail.
Yeah.
For people that, let's say, are about to renew, or they've got their renewal on the horizon, and they're looking at where rates are today, and they think they may not be coming down for the next 6 to 12 months, as an example. If your mortgage is coming up for renewal in that time frame, what is your current advice? And of course, what can they expect too? You know, if they had a mortgage from 4 years ago, what is that going to look like today? If they renew?
So really, it just for existing mortgage holders, it's going to depend in which category you're in. You know, if you have a mortgage coming up in the next year for renewal, it's really going to depend what your current mortgage rate is, what your discount is, right? I'm seeing some people with fixed rates at 2.5% or even 3% that are like, should I break my mortgage now, lock in a rate today and renew? And my advice is absolutely not, because why would you pay a penalty to go into a much higher rate when you have another year or so of a lower rate, when we don't know what next year will bring? And let's just say the rates go up another 1%. Sure, they will be higher, but when you factor in a penalty in your overall potential savings between this year and next year, I'm not sure that there is a significant benefit in that. So if you have a variable, if it's renewing now, obviously, like within a 6-month window, you might try and squeeze in before the next increase if there is one. But generally speaking, I wouldn't take any aggressive action in converting existing variables into fixed or early renewing. Now, the conversion to fixed, most variable static payments mortgages you're able to convert directly into a fixed term for equal or greater term left. So, for instance, if you have a variable that it's a year old, right? That means and it's a 5-year variable, you have 4 years left. So you can go in a 4-year fixed or more. With fixed rates at a 40-year high, I just don't want to see people, panic and jump into a fixed rate. Rates start to come down next year, now you're paying, this massive penalty. When rates are high and they go down, it triggers IRDs for all fixed terms and basically blows up the penalty. We saw it during COVID, right? People that were in 3% mortgages were paying, I had a customer pay $80,000 to get out of their 3% mortgage because it made sense for them to go into a fixed. So, is that going to happen again? It's very hard to say, but I'm sure that once we get into the 3-4% range, everyone's going to want to get out of their 5-6% mortgage for sure, right? But if you're in a variable, it's a lot easier because your rate has come down with a BOC rate. But if you want to refinance, it's only a 3 months interest penalty. So, right now, the name of the game with most existing mortgage holders is increase your payment. It's the same concept as changing to a fixed. The difference is you still keep your flexibility. Now, where some people might get handcuffed is with their prepayments. So at Bank of Montreal, we have a 20% prepayment. This is why, it's important to look at your lender's policies, because we have one of the highest prepayment options. Now, most people say, well, I'm not going to be able to pay 20% lump sum before it was about reducing your mortgages and paying your mortgage faster. Well, prepayments took on a whole new life here. It's not just about, paying your mortgage down faster, becoming mortgage free. It's, well, you want to be able to increase your payment as well so that you can keep the trigger rate away or, the trigger point away. So if you're restricted to a 10%, prepayment per year, you're going to get there faster and you're not going to have as many options, right? So, if you're with a lender that has very, very flexible prepayment options, then, activate those and pay down, at least increase your payments so that you don't have to worry too much about what's happening with all of the rates. For new mortgages, go ahead.
I was going to say, I think that's a bit of a pro tip there, Mikhail, that you sort of subtly mentioned, because most people, obviously, when they're looking for a new mortgage, it's all about rate. And they don't often spend the time or get educated enough on the terms. And things like a prepayment amount of only 10%, you're saying now that could actually handcuff people. How many people out there do you think even know what their prepayment maximum amount is? I bet it's small. I think so. Again,
I don't think a lot of people look into that too much. And, if you would have taken a 0.03% better rate at one lender and you're at a 10% prepayment, that's probably coming back to bite you right now. So it's important to do due diligence.
It's interesting. I was thinking about this whole scenario yesterday, and almost going back to, call it 2 years ago when rates were rock bottom, and everyone was chasing that lowest rate. I mean, I tip my hat to the guy who maybe didn't take the lowest rate, but locked in at like 1.7% or 1.8% for 6 or 8 years. I mean, it's definitely something I'm going to think about going forward now, having gone through this. It's not necessarily about the lowest rate. There has to be flexible options that allow you to maneuver in times like this, which we're bound to go through again. I mean, we just look at 2008, we look where we are now. These things are becoming almost more frequent and more volatile.
So with that, let's then look at people that are thinking about buying today. And yes, we are here at a 20-year low in sales volumes, but at the end of the day, there's still about 1,800 homes that are going to sell here in the month of October across GVRD alone. So I'm a new buyer, or I'm looking to do a move up. Mikhail, what is the qualifying rate today, and how is my buying power compared to March?
Okay, so, at the looking at March, or, before kind of all this madness, the qualifying rate was at 4.79%. So that was what you were qualifying at, right? That was the stress test, right? And it's pretty significant when you look at it today. I'd say the average fixed rate, qualifying stress test is about 7.7. The variable likely after today is about 7.6. So, that's a massive jump. I mean, it's almost double, right? But, the overall reduction in qualifying is very, very significant. Like, I think it even threw me off because we've been with such a fast blitz to get here. And in my mind, I always know kind of how much income qualifies for what. Like someone's like, oh, I make $100,000, I can qualify for $500,000. And, just recently, like I was doing a mortgage for a client, and, he's like, oh, I make about, 98,000. I was like, oh yeah, we should be able to do about, 485. And it was like 380. And I was like, what happened there? Right. So, it's a massive change. And I think, we're still mentally catching up to, what does this all mean? Because it's constantly switching every 2-3 months, right?
Absolutely. I mean, you got to think, like you mentioned, that's a 33% reduction in buying power. A third. I mean, yeah, you're taking a $600K purchase price point, and now that turns into 450. I mean, you are definitely moving cities, from where your ideal target was. And then let's look at, let's say, the average home. Okay, back in March here, back in February, before the hikes, average home price was sitting around 1.2 million. If you were to apply, or let's say you were qualified for that home back in February, and you tried again today, your purchasing power would be under $800,000.
Yeah.
I mean, you're talking literally almost about going from a 2-bedroom to a 1-bedroom. I mean, this is a radical change in buying power.
You're moving cities at that point. I mean, we're not seeing price reductions by anywhere near that amount, right? So,
well, that's just it, right? That's a great point. I mean, yeah, we're seeing a 33% reduction in buying power, but prices here in GVRD are only off 10%, and they've been stable for 4 months. I mean, Mikhail, maybe you tell us. I mean, the mortgage brokers are the ones who kind of have the most crystal ball look into the future, if you will, because people come to you first before they're coming to realtors before the house is actually purchased. So what are you feeling at a kind of boots on the ground level, and who's actually buying right now?
So the funny thing is that I have done more pre-approvals in the last 3 months than I've done like in the last couple of years.
What?
Yeah, I don't know what's, obviously everyone is looking at this as their opportunity, and it's a lot of first-time home buyers, a ton of first-time home buyers. The main issue with the first-time home buyers is, of course, qualifying and, getting the amounts they want, but they're being crafty. Mom and dad's coming on, brothers, sisters are buying together, couples are buying together. And, when they put their buying power together, they're getting to where they want to be. Now, the funny thing is, it's like everyone's getting stacked on the sidelines. There doesn't seem to be a ton of supply coming on. So, this whole situation seems so backwards to me. We're reducing people's ability to borrow. I don't know how that's going to make housing more affordable, and it seems almost inflationary. You're penting up demand like crazy. I mean, I counted just between August and now, we've done about 60 odd pre-approvals in that short period of time, and when you have it seems like we're almost building a massive market coming. Like at some point, all of this is going to pop, and I think once Bank of Canada calms down and everyone's like, okay, is that it? Then you're going to get everyone jumping in at the same time, and they're like, here we go again, right? So in my opinion, right now, although things they're trending down, and they could very well continue to trend down. I think that what we're doing is creating this situation where we could see an absolute nightmare of a market come spring, maybe.
I totally agree, and it does seem counterintuitive right now, but it's true, right? I mean, right now, inflation and high rates are the hot topics. Those are the headlines everyone's talking about. But let's not forget, a housing crisis was the headline just 6 months ago, and it still exists. It's just not in the forefront. And of course, what else is happening is because rates are so high and because demand is so low, all these developers are pulling back on releasing new product. And of course, a lot of the lenders aren't even financing a lot of these new buildings. So instead of building in a time where it's still incredibly needed, they're actually pulling back. So I fully agree. I've seen this before. I've been through enough cycles to know that there's going to be an intense amount of demand on the other side of this. And yeah, it might be another 12 months before people really start to come back to market, or however long it's going to be, but they're still there. We don't need to get too into immigration because we talk about it a lot. But again, here we are. We're piling people into the country. We're not building enough, and we kind of know what's on the other side of this.
Guys,
so yeah, I think you're absolutely right.
Sorry, the only other thing I was going to say to that, Mikhail, is it does feel really weird because I think at the end of the day, the Bank of Canada is going about a policy of destroying demand and not fixing supply, right? So there's two ways to deal with inflation. You either decrease demand or you increase supply. And we haven't done anything, arguably, than restrict money flow, but no other restriction on demand, right? So we restrict all the money, pile in all the people, and then we don't deal with supply, and we wonder what's happening, right? And so I feel like this is a time bomb that we're creating 100%. Again, right?
100%. I mean, I have never seen this level. It's weird because, I mean, existing mortgage holders are a little bit panicky, but I feel like there's a ton of misinformation out there, and they're getting driven in the wrong direction. I mean, I have clients emailing me like, "Oh my God, did I hit my trigger rate?" I'm like, "Yeah, but do you understand what it means?" And because they're getting their information from different sources, and once I calm them down, they're like, "Well, why am I so scared about it?" I'm like, "Well, because that's the point, right? Exactly. You're supposed to be scared by what's happening out there, but when you take the time to understand, and when you work with somebody that can put this stuff forward for you, you don't have to worry about these things." And I think right now, it's just everything's in so many different directions, and I do think that on the other side, and I've said this multiple times to my clients and to everyone, the other side of this is probably going to be a market that maybe we haven't even experienced in terms of, demand. Like we've seen the multiple offers, the no subjects, the fighting tooth and nail. And, I would be my personal prediction, and don't hold me to it, but as soon as we see a cut, I think that's when, fist fighting in the streets for real estate comes in. But I think that's what happens. So,
well, we haven't done anything to deal with the underlying issues that were there before. We've only dealt with the credit, right? We haven't dealt with bringing on tremendous amounts of real estate or massive new projects to deal with housing. It's all of those prerequisites were still there. They're just subdued right now.
Yeah, real estate, especially in Vancouver, I hate to say it, but it's largely herd mentality. And again, we saw this during the last 2 years. The hotter the market, the more people wanted a piece of it. the more people were willing to throw six-figure over-ask subject-free offers there. And then, of course, things changed, and now everybody's pulled back. Both sellers and buyers are on the sidelines. So, Mikhail, your statement, I fully agree with. And I do think the first couple of signs of a shift in the market, people will come back, and they will come back en masse. I mean, there was something I reviewed yesterday, and it said the current sentiment for housing in Canada is so low, it's gone back to the levels of April of 2020 when we were in the depths of the pandemic and didn't know if we were going to lose half the population of the planet. That's how optimistic people are in housing right now. It's in the absolute dumps. Yet it can come back incredibly quick, and who knows when that's going to happen, but it certainly can.
It also shows the effectiveness of the media as well, and their pervasive messaging, right?
So. Absolutely. And which is interesting, too, because, of course, people, I think, for the first time, there's more people paying attention to things like the Bank of Canada, like Tiff Macklem, and like rate hikes. People are actually watching this. And, yes, of course, it's because it's risen the fastest in history, so it is an interesting thing to watch. But yesterday, all over the news, there was all this public sentiment about pushback on the Bank of Canada. People are already, fighting it, and that's what's starting to get loud. And while the Bank of Canada mandates that, no, they don't succumb to public pressure, it's starting to get pretty loud, and maybe there's a few people in their ear, not public, but they can certainly start to sway a little bit of this outcome.
Well, this was the first time that the Liberals came out and defended the Bank of Canada in advance of a rate hike, right? So it was patting them, if you will, for what's coming. And that's, I guess, you have to do that when, your prime minister says he's got zero interest in monetary policy. But anyhow.
So it takes 12 months for this stuff to really, entrench itself, right? I mean,
totally.
We saw 350, basis points in the last 7 months or 8 months, and we still don't know the true effect of it, right? So I'm like, I just feel like, it's a bus that's driving out of control here, because we really don't know.
You've got GDP running at just over 3% now in Canada. That is projected to come down to nearly 1.5% by the end of the year, right? So we're talking about the economy stalling out by 50% in a few months here. So it'll be really interesting to see how this plays out. But like you said, as soon as that bank pivots, it's. I think you're going to see a big change, a big shift.
It's a very interesting comment, Mikhail, about just that we don't see the full effect of what rates are going to have on the economy and housing for 6 to 12 months. Yet Vancouver, being as unique as it is, the first rate hike started in March. The first decline in housing in 2 years started in March. It was almost an instant reaction. And of course, it went down dramatically during the first 3 hikes. And then now it's obviously bucking that trend and gone flat or sideways for 4. But Ryan.
Dan, would you argue that maybe being that we're supposed to be in a free market, quote unquote free market, that the market had already decided that pricing had gotten too high? We had already started to see some of that pullback in the market taking place, right? And honestly speaking, if you look at how inflation rates have been printed over the last 2 years, if you went back to 2021, you would have seen inflation rates hitting 3.5%, almost 4% by the end of the year. It was very clear to the Bank of Canada that things were getting hotter and hotter and hotter, and they did nothing about it. And they waited until 6.7% before they decided to do something. So for me, I feel like some of this pain could have been avoided had we acted a little earlier.
Yeah, for sure. I totally agree. And I had to double check that math when you said it, Ryan, because it's shocking to think that they literally waited, the BOC waited till inflation was 6.7 before they started increasing rates. And when they did, 0.25 was the first attempt at it. So, yeah. Very late to the game. This is all public information. We all saw it happening, and yet they reacted, in essence, about 12 months late. And this is why we also think they're going to overreact or overcorrect on this side.
Yeah.
Now,
and not to mention that they also mentioned that they weren't going to increase rates until the end of 2023. So,
yeah,
a lot of the
course.
advice given out there was because of that. So, I mean,
but take that note into account, because as we go back the other way and they start making projections about how long we're going to have elevated rates and when rates are actually going to fall.
Yeah.
These projections, in my opinion, their credibility has gone down the toilet with that stuff. So
I agree.
I'm not taking a lot of what they have to say in terms of projections with a ton of credibility. I'm going to be looking at a ton of other sources to try and gain when those indications are coming, right?
Totally agree. Now, to wrap this up, at the end of their press release, they did mention, I'm going to read this verbatim here, that given elevated inflation and inflation expectations, as well as ongoing demand pressures in the economy, the Governing Council expects that policy interest rate will need to rise further. So they are setting themselves up to potentially raise rates once again at the last announcement, which is happening on December 7th of this year. At that point, even if it's a quarter point, that's going to put us at a overnight rate of 4%. The last time we saw an overnight rate of 4% was in 2007, when the average home in Vancouver was $460,000.
Jeez.
We are now at 1.1 million. How sustainable is that? Quite simply, it is not. The market cannot sustain at that type of rates, which is, again, why I think you're going to hear an increased noise from the general public about rates being too high, about things breaking, and I think they may start coming down as early as Q1 2023.
And it's going to be really interesting to see what happens in the bond markets too, because there's other things that could force a pivot, right? It's not just going to be noise from the public and affordability measures and things like that. I mean, that's going to be a very strong one, without a doubt. But I do think that there's other financial markets and financial pressures on the economy that will also force the hand. And we'll see we'll see when that comes about. But generally speaking, if you see a bond market crash, you're going to see a pivot pretty quick.
Mikhail, thank you so much for being here with us today. For those of our listeners and viewers here that want to learn more, they want to get in touch with you, what is the best way to find you online?
Through my Instagram, or send me an email or give me a call anytime.
Perfect. We will include all those links below this episode. And of course, viewers, listeners, if you would like to get a hold of Ryan and I, there is a link to our Calendly below. You can book a buyer consultation, seller consultation, or hey, we're just free to chat about the market for 30 minutes with you. Thanks as always for watching and listening, and hope you got some value out of this one. Please share it with somebody who has a mortgage, is thinking about a mortgage, or might be renewing their mortgage. Have a great day.